In this presentation, we will continue on with part 2 of our example problem related to a private college. We will be continuing on with recording transactions with the private college. The next transaction is accounts payable and accrued liabilities ending balances of $2,185. In other words, we're going to take our trusty calculator here. We're going to go up to the accounts payable and accrued liabilities. We're at 43,511 for the time period. We're going to calculate how much of that we collected for cash throughout the time period, recording in essence the cash collections for that period with one transaction by saying that the ending balance in the accounts receivable is that $2,185. In order to get to that $2,185, we need to do our subtraction problem, that being the 43,511 minus the 2,185, that giving the 41,326. That's going to be the debit to the accounts payable and accrued liabilities, decreasing that balance. The other side then going to cash, decreasing cash. These are going to be the payments for the time period that we have paid off, in essence, on account, paying off the accounts payable with cash. Recording this out then, we're going to say that the accounts payable has a debit balance. If we scroll up top, we've got the 43,511. We're going to debit it by the 41,326. to get down to our balance to the 2,185, which of course is what our objective was to get it to. Then we've got the cash is going to be decreasing with a credit. Cash up top has a debit balance. We're going to do the opposite thing to it, crediting it, bringing the balance to the 3,277. Next transaction. Next, we have the investment earnings that are going to be received of the 4,170 and the amount of that 4,170 that is restricted for scholarship. So we got investments and the earnings on the investment we would think then would be a debit to cash, a credit to some type of income account like investment income. As we can see here, however, the difference here is that we need to break out the amount of investment income between that which is with restriction, that which is without restriction. So that we're going to debit the cash then for the total amount we've received on the investment, the 4,170. We're going to credit the investment income, an income account that would be in the dark blue area to the right. And we're going to be crediting it, increasing the revenue account in the credit direction, the amount being applied to the one without restriction of the 1,900. which of course is the 4,170 minus the 2,270, the amount with restriction being that amount of the 2,270. Recording this out then, we could see that the cash is going to be a debit amount. We got the cash debit here. We will be debiting it, bringing the balance to 7,447. Then we will be crediting the two investment accounts, the one without restrictions for 1,900, the one with restriction for 2,270, increasing those in the credit direction, also increasing what would be equivalent or similar to the net income down below, all the temporary accounts being added up, credits minus the debits, the credits winning because the revenue kind of accounts greater than the expenses. Therefore, this is increasing that amount by the 4,170. Now we're going to go through some of the adjusting type of entries. These are going to be very similar to a for-profit type of organization, those timing type of entries. If you have any more questions or want more detail about these entries, you can look at a course we have on simply adjusting entries, very similar in a for-profit type of organization and a not-for-profit. Good things to go over because they really help with the understanding and concepts of accrual accounting. So we have the adjustments to increase the allowance for doubtful accounts, the 13. You can see we have the allowance for doubtful accounts over here. It's a little bit small. I'll try to explain it in case it's a little small. We've got the accounts receivable is going to be the debit balance account. And you'll recall under an allowance method that we have to have an estimate of the amount of accounts receivable we predict not to be collectible on. That's going to be a contra asset account similar to accumulated depreciation being a contra asset account related to the equipment. So it's going to be a contra asset having a credit balance instead of a debit. The net between the two being kind of like the net value of the receivable. We're going to say that there's an estimate that that amount should be increasing. So that's a determination we made based on a calculation on the outstanding receivables. And if we make the transaction then, or the journal entry, it's going to be tuition and fees without donor restriction as the debit, and the credit going to the allowance for doubtful accounts tuition. Now, the second item makes sense to us if we're understanding this from a for-profit type of situation. The allowance is going to go up in the credit direction as it was in a for-profit organization. The debit, we're typically used to seeing bad debt expense here. Notice we're not hitting bad debt expense. We're not hitting an expense account at all. We're reversing basically the tuition, which is a revenue type of account. That's kind of what you would expect to have happen, because obviously if we're not going to get paid and we expected to be paid, what happened is we recorded revenue in the past, increasing the revenue account with a credit. It should now be going down given the fact that we now realize we're not going to be receiving all that revenue. So you would think that we would then debit it. We don't typically do that in a for-profit organization. We create an expense account called bad debt expense. Here, we're actually reversing directly to the tuition and fees. So to post this out then, we're going to say that the debit is going to go to this revenue account. So the revenue account has a credit balance. We're going to debit it, making it go down. The credits then go into the allowance for doubtful accounts. It has a credit balance in it. It's going to go up in this case in the credit direction, increasing the credit balance here. In the contra asset account, decreasing the net assets which would be the difference between the two, the difference between the receivable and the allowance. Now we're going to take a look at the record depreciation expense, the record depreciation expense of the $26,560. Now typically the depreciation expense will be increasing the contra asset account of accumulated depreciation. You'll recall what depreciation expense, it'll be very similar here as to a for-profit type of organization. If you have more questions on recording depreciation, calculating depreciation, we do have a course on recording and calculated depreciation. But once it's calculated, the journal entry is typically going to be fairly straightforward. The concept is going to be that we purchase the equipment, we put the equipment on the books as an asset as opposed to expensing the equipment at the point of purchase, and then we're going to allocate the cost to an expense as we use that expense, as we use that equipment in accordance with the matching principle and accrual type of principle or expense recognition. Now, we're not going to do that by debiting the expense account of property, plant, and equipment expense. When we allocate the cost out, we will use the account of accumulated or depreciation expense. In this case, however, we're going to be allocating the expense side of the transaction to the amount for instruction and the amount for academic support. So it will be different in that regard. Then the credit will look the same. So the credit side, we're going to say, is going to be to this contra asset account. So instead of taking down the property, plant, and equipment directly, we're going to tell our reader, hey, this is an estimate. We're going to have a contra asset account. As it increases, it brings down the book value, which would be the cost minus the accumulated depreciation. So what we're going to do then is we're going to debit, instead of depreciation expense, the allocation to the amount for instruction and academic support at the 70 and 30. So that's going to be the 26560 times the 0.7 being the 18,592. And then we have the 26560 times the 0.3 or 7,968. The credit then going to the accumulated depreciation at the 26,560. Posting this out, we have the accounts, the instruction expense and the academic support expense down below. So here's the expense accounts. They will be increasing in the debit direction. Then we'll be crediting the accumulated depreciation. So accumulated depreciation starts at the 104,440, increasing in the credit direction to the 131,000. Then, of course, if we were to subtract out to get to the book value, 385,859 minus the 160,000 would be the book value of the 225,859. The next one, we're actually going to jump down here to an increase in the unearned revenue. So we're going to take care of these kind of like little ones first. So the smaller items, we have an increase in the unearned revenues, Now that's going to be a liability account. It's right here. If it's a little bit small, it's going to be a liability account. It's in orange. It's got a credit balance in it. Typically, it represents in a for-profit organization money that we have received for which we have not yet done the work, therefore couldn't record a revenue account for it, had to record a liability until the work had been done. Only difference here is it might be there even if we had a receivable in some situations that we had to record the receivable even though it had not been earned in some cases. But in essence, it records some type of assets that we've got before we have earned them. Now, of course, we're considering the fact that we're saying here that there's an increase in unearned revenue. So we think that that amount should be increased for the adjusting entry. Therefore, this is a credit balance. We've got to do the same thing to it to increase it, which would be another credit. So we're going to credit the unearned revenue, and that means that the debit's going to go to tuition and fees. So the other side of unearned revenue that's going to be connected to it will typically be, of course, the tuition and fees. The idea being here that of the tuition and fees that we have recorded in the revenue account, some of them are items that are basically unearned that we haven't yet earned on them. Therefore, we need to remove them from the revenue account and place them in the unearned revenue. Posting this out then would look like this. We're going to say the tuition and fees is going to be the debit. We have a credit here. We're going to debit it, making it go down. The credit going to unearned revenue. It has a credit balance. We're going to credit it to bring it up in the credit direction. Next, we're going to be considering this item, which is going to be an increase in the fair value of investments of the $4,910. Of that amount, the amount related to investments restricted for scholarships is the $1,040. The amount related to the permanent endowment is the $1,080, and the remainder is related to net assets without donor restrictions. Okay, so let's think about this again. There's an increase in the fair value of the investments. So if we think about the investments up top, that's going to be some type of asset type of account. So we have the investments up top. It's going to be an asset type of account of, in this case, the $160,000. It went up in value. You could think like stocks and bonds. We're investing in it. The fair value has increased. We're then going to increase this to the current fair value, that being an increase of the $4,110. The other side of that is going to be going typically to unearned gain, some kind of unearned revenue, unearned gain. Now, of that amount, some of this is going to be restricted, however, for the scholarship. Some of it's going to be restricted for the endowment, and the amount that will not be restricted will, of course, have no restrictions. So the investments then are going to be increasing to increase them to what would be currently the fair value. Then we're going to be increasing the unearned gain on investment with restrictions for the scholarship of the $1,040, the unearned gain on investment with restrictions for the endowment, the $1,800. The difference between the $4,009, the $1,040, the $1,800 is the $2,080, the amount of the scholarships that will not have a restriction in it, or the amount of the investment increasing that will not have a restriction. Posting this out then, we're going to say that the investments are going to be increasing. So we have investments up top, the $160,000 increasing by the $4,910 to the $164,910. Then we have the unearned gain on investment. Unearned gain on investment going zero up by 2,070 to 2,070. The unearned gain on investment that is restriction with regards to scholarship increasing by 1,040 to 1,040, and the unearned gain investment that is increasing with regards to the endowment increasing in the credit direction to 1,800. We could see the effect on what would be the change in the temporary accounts down below.